meeting.
Hi, everyone. We'll be starting in just a few moments. Oh, I don't, okay. So, hi, everyone. This is May 21st, 2020, and I am honored to have Howard Silverblatt. He is the Senior Index Analyst of S&P Dow Jones Indices. He provides all kinds of data for the S&P 500, has been doing so for a very long time. He can tell you how long. I won't reveal it, but I will tell you his experience is something that we can all use. Certainly, these are unprecedented times, but history can tell us a lot, numbers can tell us a lot, and that's why we have Howard here to put this all in context for us. So without further ado, thank you for joining me, Howard, and welcome.
Thanks for inviting me.
Yeah, we really can't wait to dig in. So let's start with your crystal ball. You got to polish it off, rub it off, and look into it. What kind of times are we in? Does this compare to anything in the past? And what can we learn from past history to apply to today to make this not so bad?
Well, the main difference between now and other areas, whether you want to use the recessions, the financial ones, or the meltdowns previously, is the speed in which it took. 4 months ago, if I would have asked about Corona, you would have passed me a beer. Now, it's the talk of everything. It's totally changed our life. It was literally like putting a light switch on and off, both employment, business models, the ability to work, of course, and liquidity issues. So there's comparisons. We can go through some of them, especially the financial crisis. However, there's nothing like this as far as the speed, in modern times. And one of the most amazing things is how many people were set and able to continue to work. We're doing this now through the internet. Yeah. We've had other ones like that. Many of the companies, for example, I'm in Manhattan, but downtown is talking about, why do I need all of my employees coming back here? The same thing with the apartments for rent and the housing that's being sold in New York, is why do I need? So this is definitely a changing of the mindset. And it's the speed at which it did it, which is the main difference. But there are historical, again, comparisons, especially to the market, that we can draw specifically from the 2008-2009 financial, which happened to be the last major situation.
Yeah, so we will start digging in, and maybe, as we dig into the numbers a little bit, you can kind of harken back, to 2008 crisis, and maybe even further if we need to. But one quick question, are you at home or are you at the office?
I am at home. I don't know when we'll be in the office. We're set up, as most companies downtown is apparently set up, for elevator banks. So you go in, I'm on 44, so 41 to 47 goes to this area, and other ones go there. The estimates are, depending upon what company you are, anywhere from 15 minutes to 45 minutes to get in, depending upon the kind of tests they're going to do. And that's using about an 8 o'clock New York time entry level. The traders, obviously, they're figuring 15 minutes to get in, because they'll do that. But I am Midtown Manhattan, and it is eerie. I was born and raised here, and it's empty. It's strange.
It's eerie. I was in New York a couple months ago, and standing in front of 6th Avenue and 42nd Street, empty, completely empty. It was amazing. And also, we've seen that Facebook, Twitter, Google, these companies have all said that they are extending work from home probably through the end of the year, and then there's kind of an open end on it. So.
Yeah, Twitter's actually going farther. Dorsey actually, put out, you can stay home as long as you need to. And a lot of companies are talking about that as a possibility, depending upon how you're set up. Again, if you're electronic, if we wanted to have this and I was in Hawaii or I was in London, it wouldn't make much of a difference to it. Why do I need to go downtown to an office building, spend longer trying to get in than my commute would be?
Yeah, Hawaii is harder because of the time. Because I spend so much time traveling. I always like being in London because I can wake up and I'm way ahead of New York. But being that far behind New York, oh my goodness, it might be hard. But okay, so let's start digging into where we are and where we're headed. Let's talk about EPS. So for those of you that don't know what EPS is, that's earnings per share. That's basically the it's how the companies tell you whether or not they're profitable, if they're doing better this year than last year. And you showed me a chart that looked pretty dismal for most of the industries, but not so bad for some of them. Do you want to dig into that a little bit, earnings per share?
Sure. There's two sets of earnings that analysts use. One is called GAAP, Generally Accepted Accounting Principles. That's when you go by the books, whether I do it or you do it, it comes out to the exact right profit amount. And that includes charges and costs that companies have, all the Boeing items, the energy write-downs as an example, all the closings that you had now on the retail side. So for this quarter, as an example, it's coming in about $12.50 per share, as compared to $35.53 last quarter. So you are down 2/3 on that. Imagine your paycheck and you're still getting paid, but you've taken a 2/3 cut on that. And next quarter is not supposed to be that much better. The other number that's touted about and does not have a legal definition is called operatings. I make widgets. How much did I make for my widgets? Don't tell me I had a cost that I had to buy a new plant, or that I'm moving somewhere, or that I'm buying equipment. How much did I actually make from widgets? And we get into a lot of disagreements with companies. As times get difficult, as we do have, as an example, a lot of companies say, yes, I would have been so much, but I had to close my stores. Therefore, I had no sales, so I'm restating items pro forma and putting those items in. Now, using the operating, last quarter was about $36, that's Q4. This quarter, depends who you go to. If you use the pro formas where it's basically everything but the bad stuff, you're getting about a $33 number. Not bad. You had a small tick down. You wouldn't think that 36 million people file for claims, or that we're expecting 20% unemployment, much less that I got to wear a mask everywhere.
Yeah.
Use methodology and say, okay, if the company took a charge, for example, they wrote down their royals, they closed their plants, we come up with $20, which is about almost half of the number from last quarter. That's how quickly this happened in one quarter. At the beginning of the year, the estimate was for about $38, and now it's coming in, the actual Q1, we have $20 even, with next quarter being $23. So the earnings have taken a significant cut no matter which definition you use.
Right.
The cash flow, that's actual money, and liquidity is key now.
Right.
More than anything else. When you look at the cash flow, it's not as bad as that $20, but it's nowhere near as good as $33 or $35. It's coming in pretty bad. It is going to hit the companies on a cash flow basis. That is why so many companies are looking to maintain liquidity, because money will get you through the situation, in spite of how much the Fed prints up or distributes.
Right. So I think we should definitely go into buybacks, preserving capital, and the cash coffers. But before we do, let's talk a little bit about earnings and the other side of that, the P side, price earnings ratio. How do you feel about price to earnings ratio? Because it seems like the markets have come back up, and yet all of the economic data is alarming. So what do you say about price to earnings ratio and the rise in the equities?
Well, as far as PE goes, let me get a tissue because I may get a nosebleed. We're so high now. Historically, we're dealing like 17, 18 on a high side. Now we're in the 22, 23 range. Again, the earnings are down a lot now, expected to get pretty bad next quarter as well. However, the market is not selling on the current earnings. We're discounting going ahead of time. 2020 basically has been written off. The hope and what's holding us up is that we see a curve because of the reopening or less virus, whatever the reason, that we see that we hit the bottom in Q2 and Q3, Q4 turn up. So we're selling on forward earnings 2021. At that point, we're still a bit high. Should typically, that far in advance should be about a 15, 15 and a half. This is on operating.
Yeah.
But we're over 18 at this point. So the market right now, the disconnect, as you put that, we're only down about 8.5% year to date,
Yeah.
which is an amazing fact. That we are discounting the earnings now and looking forward that we are going to get past this. And that's what we're selling at. So it's a very high multiple we are putting on there. So if we do not see that improvement, again, not to get back to where we were, just that we've gone up, we've made the turn, we're having improvement. If we do not get that with those 3Q numbers, and as we get to the end of the summer and see the sales and the retail situation, what's open and what's not, we're going to have to reprice, out, and that repricing could be costly going forward, because again, we are paying a nice premium on it. When we do reprice, if we do reprice, obviously, it's going to differentiate between those that are open, those that have cash. The way we're seeing it in retail now, the difference between Kohl's and Target, as an example, or so we would expect more volatility the way we had in February and parts of March.
Okay, so I don't want to put you on the spot if you don't want to be, but for those people that don't speak market parlance, can you give maybe a shopping aphorism that would help to explain what you just said?
Sure. Kohl's, Home Depot, Walmart, Lowe's, they did much better. They were open. Okay, so people were able to go there and buy from them. Target was open because they were food considered essential. These companies have done well. Whether they should have or not, there were fewer places out there to go buy. So they did well. Not all their profits were good because costs were up, but they saw large increases in their sales. Walmart was 10%, 74% for e-commerce. Home Depot was up, but again, their costs hurt them. So these companies have done well relative to everyone else. Companies such as, again, not to pick on Kohl's, I buy things there, but they were closed. They were not considered essential. They didn't have food. You didn't have to buy there. So for the 3 months, for example, ending April, because they're in our fiscal and that's when they report, they had a 41% drop in sales. Year to date, that stock is down a little over 60% compared to the Walmarts and Targets, which are slightly up. Again, as we get farther into the year, we will see, for example, if, just for the analogy, Kohl's starts to open up, do consumers go back there to get their things? And does that mean that they'll get less at the Target one? Or Walmart, so it shifts back. And if the answer is yes, you see a nice rebound. And yes, maybe that stock was good and the other ones have to start pricing down. But if they don't get it back or they can't open because we get a reoccurrence of the virus or something, it continues on, which means that if I want to get that merchandise, I have to go to the store that's open, have to get Amazon to deliver it to me, and I cannot go mostly to something, again, such as Kohl's. And I don't mean to pick on them.
Yeah. I mean, you could pick on Neiman Marcus and JCPenney if you wanted to as well, right?
It's hard with JCPenney. They were all the way down there. But yes, Neiman Marcus is an excellent example of a higher end store that can't maintain its volume at this point. And how do you sell apparel when I can't try it on? That's becoming a major, that was already a major issue for a lot of companies. They would go e-commerce and they would send 3 shoes out and then they'd return 2 because you couldn't get the sizes in the store. Now, if I can't get to the store, how do I do that?
Yep. So I think that this naturally does lead us into a couple of the other conversations about preserving your capital. When I was looking at, and from the beginning, the Feds marched in there because things had really dried up for even borrowing money in March 2nd and certainly by March 15th. Some of these companies, we've seen the Federal Reserve Board and particularly Jerome Powell saying they have lending, not spending. So they have to be assured that the company is going to pay it back. I think that a lot of people don't understand that companies can restructure, stay open, but your stock really goes in the toilet if it becomes anything, and the bondholders usually take a haircut. So what industries are you seeing that might be more vulnerable to having to restructure based on liquidity or not able to preserve their capital?
Well, obviously, we spoke about J.C. Penney as a prime example. Again, who was not doing that good to begin with, but 18 cents for the stock. That's not doing too well
Yeah.
on there. So as they get more financing, or money is given, they go into bankruptcy, as they did. They go for protection. Hopefully it's 11, so they continue on, not liquidate like Horton Taylor is doing.
Yeah.
So the equity position in there is extremely high risk, and you are literally last on the road to get paid. Payroll goes before you, all these IOUs go before you, secured, unsecured, then the equity person goes. So these retail, which everyone is expecting an enormous amount of consolidation from, is a very risky area for those who are not open and who cannot cover their sides. For a long time ago, we had a company called Alexander's in New York, which was a lower end discount.
Mm-hmm.
Ended up that they owned all their properties, including where Bloomberg sits right now. Became a property company. Right now, if you own property or long-term leases in major areas, whether it be a mall or a city, they're not valued the way they were 3 months ago. There's a lot of movement in there on real estate. So the retail themselves are hit by a lack of sales, and even if they have physical properties, that is now deteriorated as far as its value. So retail probably is one of the riskier ones on there, even compared to, say, energy.
Yeah. Okay, we'll go for energy in a moment, because that was unbelievable. I mean, isn't there still a supply issue? I mean, the reason that they had to pay to give away it was that where do we store it, right? But isn't there still a problem with that? Like, where do you store it?
There was a supply side and obviously a demand side, and you had the war between Saudi Arabia and Russia, not a physical war, but a war of the oils, and they both wanted to, shall we say, put a dent in the U.S.
Yes.
Most wanted to fight themselves. We had 14 weeks. There's a weekly EIA, that's the Energy Administration, puts out of inventories. 14 weeks in a row, inventories had gone up. It continuously went up. There was just so much supply. Then you get Corona in there, and people start driving less. They're not going there. If you looked at the price of gasoline, again, using the all grade, I think it was about $1.97 last week. It was $2.48 at the beginning of the year.
Yeah.
Half a dollar down, 18, 19% down on oil prices at the pump. The negative item on there is that while that would normally help consumers, they're not traveling as much, so they're not getting that money there. Yes, it reduces the transportation for products, but who's ever transporting product has more expenses due to Corona than saved on that oil. But oil is back up. We had the negative, obviously. We were 34. We hit $34 today, a tick under right now. Futures are still bad, but we still do have more of a supply problem than a demand, and the demand is significantly down. Last 2 weeks, we've had an slight increase in the EIA inventories, so that has helped a little bit. Yes, oil has gotten hit by both sides, and the energy companies obviously got hit on both sides.
What are the futures looking like? Because I would think that this is still, especially with work from home. Yeah. What are the futures looking like? Do you have that number top of mind?
They are improving on there. There still is an enormous amount of trading. A lot of people took a loss, by the way, on those negative numbers.
Yeah.
We don't have stats on who might have gone under or how they covered it, but there was a lot of trading in there at numbers that were in the red. The future numbers get a little bit more positive. What's going to control it a lot more is how much Saudi Arabia and Russia, who have agreed, actually pull back on it. So if they could pull back and you get some reopening in America, okay, you get that shift, so a little bit less supply, a little bit more demand. But if you're expecting it to go back to that $2,405 price, you better hopefully reverse stock split.
Yeah, so those of you that think, oh, it's so low, think again, because work from home is going to impact demand.
Yeah, as it will everything. Shirts do I need? I mean, my dry cleaner. What's he gonna You know.
How many shirts do I need?
All these items go together. All the
It's
people
true.
that do things to us, you know, whether you be in a city or you're in a rural area,
Yeah.
you know, that commute to work, that's a lot of extra time.
And you know, it's interesting because I was thinking, well, instead of buying a new wardrobe, the new thing, like the new status symbol is, how does your background look? And by the way, you know, I'm just thinking, how many times am I going to change my background for each one of these video conferences? So obviously.
I was thinking of doing one downstairs. I'll put the you know, buildings in the background, or we can walk up to Grand Central, which we could shout through. Now there's nobody there.
The lighting there, it's, yeah. Okay, so commercial real estate. You know, while we're talking about work from home, you know, I was looking at some of these, there, like Google was in a couple of deals to actually transform malls that had completely been vacant for all these years. They were going to make them into the new Google campus and all these projects. I'm just wondering, I mean, because I did see that Jerome Powell called out that commercial real estate could really be an issue. What are you seeing in your data-driven analysis here?
We're hearing a lot more because we haven't seen yet. It doesn't, you know, companies talking about potentially satellite offices, malls obviously concerned about the traffic they get, much less the anchor ones such as a Macy's or something. Obviously, JCPenney's no longer there, but you know, the anchor stores on there. So we expect a significant shift in real estate. What we are seeing currently is that the suburbs around cities, and I'm using K-Show items here, they appear to be increasing. The pressure to buy, ones that we have seen, you know, for March, again, there's lagging time periods here. It seems like there's almost battles to get there. Why am I staying in the city if the restaurants are closed? Why am I staying in the city if I'm not going into the offices? So the suburbs outside the cities, which, you know, some people will commute 2.5 hours. I mean, I know people coming from Philadelphia into New York. You know, I mean, it's a big commute. So we are seeing some of the real estate there. The larger concern is some of the malls, and obviously all the stores in. How do they deal? How do they address that? And as the mall operator or the owner, what do you do with rents? If you reduce it for one, you've got to reduce it for all. It's not like the paycheck where I don't tell you what you make and you don't tell me what I make.
Right.
There could be issues there. So we hear a lot more, but the only data we've seen is some shift in that resale of homes. You know, the price is going up, and of course the supply has gone down. Not too many people want you walking through. You know, use that virtual tour.
It's interesting because, you know, I wanted to also include Gen Z and millennials data in here, because the data prior to this was that the millennials and the Gen Z really preferred an urban setting so that they could walk to work or maybe take micro mobility. I'm wondering if this will, I mean, these are all just things that we have in our head, but I think we have to acknowledge 20% unemployment. I think we have to acknowledge, you know, all of this, like overnight, things have just shifted. We have new norms that are taking place, like work from home, like intergenerational housing. You know, what do you, anything that you're seeing in the numbers that are more for the younger generation that you want to highlight or talk about?
Again, the numbers sometimes take a while till they get in there. The surveys that we've seen as far as multi-generations, you know, kids coming back to mommy and daddy. My son is with me now. He's 23. He graduated. He went on vacation, came back, was looking in January for the place. Wasn't a good apartment. He's back home. So I've got him here, and I hear a lot about that. Most of the in the neighborhoods here, my daughter is 25. In her building, she's in a high-rise building. There's about 40 tenants left out of about 400. And that was mostly like, they used to call those dorm buildings where 2 and 3 kids get together. They get a 2-3 bedroom apartment. They sometimes have something called a flex room. You can afford what you can when you get out of school if you have a job. And they all went back to mommy and daddy, which nice shortly, but over the long term, that could be difficult. Now, a lot of people have lost their jobs. They may not have something to come back to, and they're still paying New York rents. There's eviction concerns and everything. So as far as people getting out of school now, some have been lucky, and companies, and if they had a job, companies have said, yes, we'll keep you there. They're mostly doing what some people would say the right thing, but they're, longer term on there. But a lot of people did not have jobs yet. So you're going to be looking for a job, and it's going to be difficult. As far as the ones that were already in the city, they're going to be asking themselves, if I can work from anywhere, why am I, paying 40, 50% of my income to rent?
And, I want to also go down this path again on the jobless claims, high unemployment, that sort of thing, because that's one of the things that Jerome Powell was talking about on 60 Minutes and also in the Financial Stability Report just last week. He's saying, look, the other side of this is that, and we've certainly seen big, VIPs like Mark Cuban talk about it. These businesses can stay open, but if they don't have people buying stuff, then that's going to be a big problem for us. Prior to this, I think it was 69% of GDP was consumer spending. So what do you see in, again, and I also want to talk a little bit about this too. When you're talking about numbers, and I'm so glad you pointed this out, is that the numbers show up after it happens, right? Because a lot of people aren't aware of that. Like we right now, there's nobody I know on the economist side, and as well as all of your colleagues, we're in a recession. But the general public does not know that until they get that second quarter of GDP, which comes at the end of July. So
and that's the initial one. It doesn't finalize till September.
Yeah. Oh, so you think there's going to be a lot of, as they say, kicking and screaming and throwing dirt in the air, right? Until it's finalized.
Yeah. So the difficulty obviously is that we do need to at some point open up America. The question and the difficulty obviously is the trade-off, and it is a direct trade-off, and it's become extremely important. You tell me where you live, give me your zip code, I could probably tell you where you stand on it. The bottom line here is that the Fed has done, at least put an editorial underneath me, I think he's done a very good job. He's reacted very quickly. I have no doubt in 3 years we can do an academic study and show how many mistakes he made.
Yeah.
He was on the line, they did it, and he did the liquidity. Similar to the Lehman Brothers situation. When Lehman Brothers closed, whether you thought they should have been bailed out or not, they were like the mailman who kept the money moving. When you close them down, nobody delivered the money. The Fed helped the liquidity issue, not just for municipalities eventually, but non-investment grade debt eventually as well, because they've extended it onto there. So the Fed has done a very good job, but they could just print up or loan or play with their balance sheet so much. They, fiscal and monetary have to work hand in hand. So you need the government to do their part. In the end, if the economy does not open up, they can't print quick enough. They'll have to start adding zeros to every number on the back. So you really do need to open up the economy, but the difficulty is in doing so. Some areas are safer than others. How do you judge? Who judges? And unfortunately, the politics of it.
Yeah, and then how quickly can people get back to work, and how quickly will they start shopping, and how will those shopping trends change? There's so many ifs in this, right?
If you open, will they come? That's the main item. I mean, how quickly would I go into to another store, go on an airline, much less go into a bodega and use a salad bar? How quickly am I going to do that?
Yeah.
Just so all these items depend on the virus. Companies, that's what's so much uncertainty now. I mean, if you knew exactly what it was, we're going to have this, it's going to go into next November, and this is the cost of, you could plan around it, what to cut, what to do, what to order. Yeah. But knowing there's so many branches on this tree, you can't do planning. Corporations can't do planning. Individuals can't do planning.
Let's talk about the liquidity a little bit, because as you said, the Feds went in there. I mean, it wasn't just the bond market that was frozen up. They said the mortgage-backed securities market was frozen up. They said the money markets were frozen up, and they said that
Well,
the treasury bills.
they were worried about breaking the buck again.
They were. I mean, they still have, now they have liquidity fees and redemption gates, which a lot of people don't understand or know about, but that might have helped a little bit. But, you know, they basically, I mean, things that even treasury bills had frozen up because so many people were selling their long-term treasury bills. So let's talk about that, because Jerome Powell has been very specific to say in the last few speeches that he's given, we have lending powers, not spending powers. And so they cannot lend to entities that they do not believe will be solvent enough to pay them back. Are there concerns from what you see? We have to address, and okay, this is going to be a two-parter. The amount of companies that are consolidated at just above junk bond status, or the highest rung of speculative, over half of S&P 500 companies. So that's question number one. And then I also want you to address the amount of debt that the U.S. is now in, public debt. I mean, when we add in everything, it goes to the astronomical sphere. But the public debt side, which is now what, 25.5 trillion? Are you worried about it down?
For a while, it was, the S&P 500 had a higher market value. Remember, we put out a notice when they crossed. Well, now you got that double cross on there. First, let me say on the bonds that I'm not a bond analyst. I look at the fixed income from an equity point of view, and I have no connection to S&P ratings.
Right.
Otherwise, I'll come down and shut me down here. But yes, the debt numbers, the companies beforehand were in decent shape. I'm talking about the S&P 500, the higher caps, even with somewhat lower ratings. They had access to capital. Yes. They had enormous cash reserves on there. Interest expense was extremely low, similar to your house, how many times they refinanced on there. So they were probably in very good shape to enter this situation. Okay, it's a different debate about whether they should have spent some of that money on something else or what they actually did spend it on. I think you mentioned the buybacks and everything, but they did have significant cash reserves in general and access to low interest going into this. That said, if you
just real quickly for those of those listening, that is exactly why we had so many that were willing to drop all the way to BBB, right? Because they could still have access to capital, and it was still really low cost, maybe 5 to 6%, right?
I can't.
You can't comment. Okay,
a certain rating, but the leverage numbers for these companies obviously were not out of whack historically, but they definitely increased. They started taking on more debt. Interest rates did go down, but if you had fixed rate, it was fixed rate. If you had a variable rate, which very few had anymore because it was so low, just lock it in there. If it goes down a quarter, who cares? I mean, you're all the way down there anyway. So companies have added liquidity to it, not just through bonds, but also offerings. Mm-hmm. A lot of S1s updated. You always have something on the shelf there, and every once in a while they update it, but you're getting a lot of updates in there to get cash through equity markets as well as the debts. The good part is that interest rates are still low. However, when you move down that rating scale or the perception of your business cycle, where you are, again, if you're in something where is not open up yet, or you don't have a defined supply line in there that's coming up and controllable, you got an issue. I mean, that the burn rate of some of these companies, again, I'm going back to Kohl's again. They're not going to let me in the store. But if my store's closed, I'm not doing too well on sales.
Yeah.
I can't be, I still have rent. I still have costs. I still have some people that have to be gone, and I still have inventory. I have another season coming up. The food business, how many of them are being able to get their food? Will Cisco ship them? Cisco, not the tech company, but the food company, Cisco. Yeah. How much they're saying that people did not necessarily, with small restaurants, pay them. How are they going to, when they start? Oh, well, they didn't have the money. Usually you work on a small market. They're going to have to pay something. I mean, you might want to give credit. You can't shut your customers down because that shuts you down, but you're going to have to come up with something. So liquidity is the main issue here. Having money, access to money for debt, or however you do it. So the Fed can just put out so much. At some point, if the economy doesn't start moving up, the Fed can't do it.
Let's talk about then the liquidity and the cash burn, and let's do it more from an industry standpoint, because I know we've beaten the sad and vulnerable horse here, which is retail. And we've looked at commercial real estate, which has had a transitional problem in the past, and now is going to have a problem even with their office buildings.
And no one said WeWorks.
Yeah. Oh boy, WeWorks.
Let's not go there.
Yeah. Okay. So, but let's also talk then about some of the industrials: planes, trains, automobiles.
Or technology, if we could start.
Yeah, and then, okay, you want to start with the good news, technology side?
Yeah, technologies typically has more cash on hand. They have less debt.
Yeah.
Options, obviously, buybacks more because that's part of their compensation. And a lot of tech has been able to handle the situation. Obviously,
we're using more of it even.
Yes, because more PCs, it's harder to get PCs now. Get a laptop, get something. All this is in demand. Connected to web, what we're doing is more in demand. Also, e-commerce, more in demand. So technology is really sitting there at the forefront of that. They were well positioned to do that, and with good cash, low debt, and didn't have to worry that much about the burn rate, because a lot of their people can still go. If we go to the industrial part, used by getting there through manufacturing part of IT, which could be IT semiconductor company, it's still IT, but it's still manufacturing to some degree. Yeah. Those have to worry about opening up the plant, whether they be the semiconductors or had to close yesterday and part of today, but was able to come back today to go. So they're going to have to work their way around how do they do a plant. It also speaks to eventual quicker automation on there. But as far as the industrials go,
let's stay with technology for a minute. So you made a very distinct point here, which I think is important. So you're saying kind of like the Intels of the world versus Microsoft, Amazon, Apple. Well, Apple is going to have a retail problem, but
a software company, or such as Microsoft, or somebody that has the rights or has those items, they're selling product. Yes, there's some manufacturing in there, but it's not like physically. I need somebody there to do that semiconductor. I need them in the plant to produce it. I then need it shipped. And for semiconductors, it could be coming from China, Taiwan, or Japan. Has to get over to here. Somebody has to unload that boat and get it, to the shops.
That's interesting. I'm glad you made that distinction. So, and by the way, for those folks, if you're now all of a sudden fired up on technology, the price to earnings ratio on the technology companies, if you thought you had a nosebleed, you're now on Mount Everest, right?
But technology is positive year to date. They are one of the ones that are doing well, and they should. The way we're discussing, why they're doing it, but basically they're getting through on there. Energy's all the way down. They're on the bottom side, and financials. They're doing terrible.
How are financials going to do? Let's talk about the big banks. I mean, we should talk both about big banks and small banks. A lot of people are worried about the small banks too, and they do become more vulnerable when people can't pay their mortgages and their credit card bills. So, financials are all these different things. There's the ones that are more into mortgages and ones that are more into credit cards, like Discover Financial Services. And then you've got, obviously the big banks like JP Morgan and Wells. So what are you seeing here? I mean, I would assume that JP Morgan, they say they're capitalized well and they're going to do fine. But what are you seeing? Earnings probably are going to be way down on everybody, you think?
I've never seen a financial institution say that they did not have good liquidity right up to the morning where the Fed forced the merger down their throats, including back to the Lehman days. Excuse me. But yes, the larger banks and the small banks have different exposure, as you mentioned. There's a lot more on the person to person. I am a local bank. You come to me. I am loaning you money for that. I have direct exposure. I may sell it up to the big banks, and it could get into a fund or something and end up at JP Morgan or somebody. But the local banks have more of that exposure, as well as the local merchant on Main Street that may not be able to open. The restaurant numbers that we see for the possibility of not making it is amazing. I mean, even the best scenarios have a third of them going under, and you don't want to know what the rest of them are. You go out and buy food now. So the locals have a lot more exposure to the local items as compared to the large ones, which also have institutions. They have exposure to large corporations that they have to properly price. So it is a differential between the two. And also the large banks, they have, as you know, the charge cards. Charge cards, the expectation, don't see the numbers yet, the expectation is that the default will increase on autos as well. Will go up, maybe not to where they were in 2009 and 2010, but will go up.
Right.
The amount of charges that have been being put on those cards has significantly gone down. That's good, a lot of revenue for the larger banks. And since they're not being charged, it's probably also the smaller companies and regionals that are also being hurt by the company, that store in town that's not getting the sales.
Yeah.
So financials, again, have done very poorly year to date. As far as loans go, how do I make a loan to you and cover my costs when rates are so small? High inflation permits me to play the spreads low. The only thing, it's not good for anything on there.
You want to go, well, we'll only spend a little bit of time here. You can probably sum it up in 5 words. Airlines, Boeing, what do you think? Auto manufacturers too.
I differentiate between airlines and Boeing. The airlines obviously have gotten enormous hits. It's going to take years to come back. I'm not sure how they're going to be able to do it 60% loaded, 50% loaded, but it's going to take a long time for people to want to get back, and they may not get those business travelers back, which are high margin items. Boeing is a different situation. Remember, we had the problems with the MAX, and then you had the difficulty now. You can't just start up a company. Or you can start an airlines by buying a bunch of airplanes and a name from somebody that's going under. You can't start a manufacturing business for an airline. You can't compete with Boeing. Like you are Ford, General Motors, and Chrysler. You couldn't make another one. U.S. Steel. You couldn't create a Bethlehem, another company on there. So the long-term view of Boeing is that, yes, it has to survive because they're making planes, and eventually you need that.
Yeah. Short
term, a lot of pressure, a lot of burn money, a lot of fewer orders. It's more than bumpy. It's turbulent.
You're seeing their cash burn's pretty bad then, in other words. Are you restructuring?
Yes, they're not getting the orders. They have nowhere. We spoke about nowhere to put the oil. Where are you putting the planes? I mean, there's parking lots there. And they've laid off people. They initially, remember, under the MAX, when they had the MAX problem, they were not doing that. And there was a lot of positive press on that they kept their people, even though, and that they had the money to do it. Then they had to go to the debt markets. Obviously, they got rid of their dividends, and as well as buybacks. But longer term, you need a manufacturer of planes. It's not like buying a license that I could fly from New York to Chicago and get a small airline and some extra planes and build it up, which is still capital intensive, but nowhere near what's needed for something, again, like a Boeing.
You've been very generous with your time. I don't want to take up too much longer, but we did, if you have the time, I would like to talk about buybacks and also dividends, obviously, because a lot of people own the value funds and they were relying upon the dividends as their income. So we do need to talk about dividends. And in terms of the buybacks, I'm just wondering, do you think that we had the fastest descent from bull to bear because there was no buyback support?
No. It would have been nice to, well, first of all, in Q1, okay, and again, for a good part of it, we hit a high on February 19th.
Yes.
So most of that month, most of that half, more than half there, we were flying high and having champagne as compared to whiskey that we're doing now. Okay. Q1 actuals, I have about 90% of the actual buybacks in there, and they were strong, very strong. Companies will go get, I'll redo them again. I had just about 90% last week. I'll redo them this weekend. Companies were headed for that $200 billion mark, which we hadn't seen since the heydays, after the tax.
You don't think it was front loaded? You don't think it was maybe January, February 19th and then stop?
We haven't gone through all of it yet, but when we looked through it, January was strong. Okay, they get a lower period because the earnings come out and companies don't want to buy around that area until it's dissemination. So you do get a lull there. But we saw it for March. The beginning of the year, the end of there were a few estimates that maybe we hit 200 billion for the quarter. Yeah. In February, we were all talking, in February and March, a few people were putting numbers out on there. We were talking 120, 140. How nice it would be to beat to 140. I've already got about 165 billion booked, companies reported, which looks like it'll be about 200, may make 200, may not. So companies continued on, including the financials, which mostly cut the 15th of March. So they did what they were doing. So we were on the uptick for the actual buybacks. Q2, don't expect you won't be disappointed. The last look I had, 73% financials already said we are doing nothing for Q2.
Yeah.
Okay. So buybacks, it might have been a support if companies kept doing it, but it wouldn't have made much of a difference.
Did you say 73%?
73% and canceled by dollar value. You had the 8 the 8 big ones right after the Fed, the meeting on the Fed came out and did it in unison. Usually, if you have 8 of the big banks together in the same room, you've got compliance issues. But here they came out and they stopped it right away. And other companies, obviously, I mean, we spoke Boeing, but these companies. But you still have Microsoft, you still have Apple, which is the buyback.
King.
Apple, right? It used to be Exxon years ago. But so buybacks, we believe, is an endangered species at this point.
Except for Apple.
If you took any money from the government, you can't do them. But if you took money, you shouldn't be doing it anyway.
Yeah.
So outside of some tech issues and cash ones, we don't expect buybacks a lot. Dividends is a worse story.
Okay, before we go dividends, I do have to ask this question. So who did it? Who was doing all this selling? I don't think it was Main Street.
I could bring up with it up and down the line. They all were doing it in Q1. The banks were up there. Apple was number 1. Microsoft was up there, but JP Morgan was there. They were there. They were all doing it. They may have closed up afterwards.
Yeah, but no, what I mean to say is that, from the knife drop that we saw from February 19th till, about March 15th, who were the sellers? If the corporations were still buying back their stock and Main Street didn't have the memo, then who was doing all the selling? The drop that we had, which started to get worse. I mean, the initial look was similar to the housing situation. Gee, it's a small situation. We'll get through it. We're going to ride through this one. And talk among financial heads, at companies, should we double up on dividends on the buybacks right away? Because they have certain options, and they know that they need so many for employee options just to begin with. Forget about account reduction or increasing EPS. So the debate in like early February is like, should we double up on this? Yeah.
The bottom number is that the numbers Q1s were excessively high, no matter how you what time period you want to look at it. Much less when we were looking at it in March and saying, gee, 140. A lot higher.
All right, so let's talk about dividends, because I think this is important. There probably are some fixed income people that are going to be watching this back, and I think it's important too. So we have 73 of the corporations that are suspending their buyback program. How do you have a percentage? 73%
of that. That was 73% of the financials.
Of the financials, okay.
Yeah, within the index, okay, and we'll start there. Because that's where most of the money is, on a dollar value. We've had Q1 ended with a record dividend payment. Remember, you declare your payment now. You got holders pay X date. You get it on. So it's kind of front loaded to some degree. But Q1 was a record amount. $126 billion in the 500 alone was paid out. So you made more than you ever did. Since mid-March, we've had 37 suspensions in the S&P 500. The prior suspension was in 2017. We've also had 17 cuts. It's unusual to have so many more suspensions and cuts. And the reason you have it now is because companies had no time to react. They couldn't say, I'll ride through this. I'm going to, let's see how it goes. I can pay this dividend. Let's go. If you were an airline, if you were a hotel, if you were something tied to or entertainment, that you were cut off almost instantaneously. You did not have the ability to say, should I pay for this one and try to live out the quarter? You had to cut it off. You had to worry about your payroll. You had to worry about your property, everything, the taxes, what you had to pay it there. So we've had 37 suspensions, which is more than we had in 2008 and 2009. That we had a lot more cuts, but not suspensions. It was slower, it was played out. So dividends within at least the 500 has had a bigger impact. Outside the S&P 500, looking just at U.S. common domestic markets, normal trading, no UITs, or LPs, or royalties, normal quote common stock, if we can get that by some compliance person, it's worse. That over half the issues are also liquidity. Most of them are smaller companies, and they had no choices. The lower you were on the totem pole, as far as capitalization go, not quality necessarily, the harder you were hit. On the high end, it seems like quality counts out. Companies that have a history of paying a dividend, and it's part of their cultures, okay, are doing a little bit better. Within the 500, it's more diversified in there. They have better global numbers and everything, not as much retail on there. We have 66 issues in something called the Dividend Aristocrats. Those are companies that have done it 25 years in a row. There's a lot of funds like that that have different things. You don't need 25. I do it 10 years in a row. It's part of my culture. My CEO, everyone's talking about it. And as an investor, you're expecting that paycheck. And by the way, that dividend, whether you use it for DRP or you use it to live on or reallocation or something, that's actual cash. You can't pay it with those fake earnings, pro forma.
Right.
You either have money in the bank when you send me the check or you don't. So the higher quality companies have been able to do it. We've got 28 of those already have increased this year to date.
Apple being one.
Yeah, and they appear to be able to ride out what is perceived now as a downturn, not just for the Q1, the Q2, into Q3 with a turn-up.
So you think maybe AAA and AA are going to fare better?
Well, you need to look at the product base and their cash flow on there. But again, most of these, again, I'm just using the Aristocrats as an example, but you don't need that 25-year to do that. Most of these companies have still cash flow. They've got good reserves, and they can pay. So they're living through there. Their burn rate is not as bad. Doesn't mean they're all going to make it, but so far, we've had no actual cuts within those companies. And we've had, again, 37 outside of them in the S&P 500. Again, consumer groups, ones you would expect.
Yeah, yeah. I think before, and again, I know we got to wrap up and I want to give you a final word. I do want to talk a little bit about cash burn by industry, if we might. And I also want to, I may have to say this because you may have your hands tied not being on the bond side, but I have been seeing in a lot of the loan covenants that the money cannot be used for buybacks or dividends. And oftentimes there's even a limit on bonuses and that sort of thing for executives. So
and some of that is also in the government numbers.
Yeah.
In general, bond people hate buybacks. I mean, if you had them on here, you would be bleeping them out for every other words. A buyback, while we look at it and say it supports equities, it's more buying, it reduces share count, increases my share of the company, and increases EPS, they look at it and say it does nothing for the timely repayment of debt and interest. Or
R&D, or investing in brain trust of your people. Yeah.
Just like we're looking at the equity item, they're looking at the bond. They're looking at that bond. What's the chances of it being paid back on a timely basis plus the interest? And buybacks is a cash drain going out, nothing coming in. The stock can go anywhere you want. It can go up forever. Bottom line is you need to pay the interest and the principal on that. So we are seeing more restrictions on there, but bond people have traditionally looked down on buybacks and put it on the negative side. Just to how they consider pensions to be a long-term debt, which has been declining, of course, because most people, they're closed pension programs. But yes, we're seeing covenants in there. I don't know about the private restrictions from the banks. That's the big item. We have some services that are supposedly looking into that, but I have not seen anything on that. So if you go to JP Morgan, you go to Citi, you go to Bank of America, what's the covenants on those?
Well, I was watching some Mike Milken on some of this, and they were saying that prior to the crisis, that they're really, if you didn't borrow from JP Morgan, or if JP Morgan wanted to put in loan covenants, you just went over to Wells Fargo. I think that has shifted. The competition now thinks they probably don't have their hands tied and they can't ask for more. But certainly prior to this, they couldn't, because the money, everybody wanted that little tiny bit of rate of return. But let's go through the industries on the cash burn. Like if we're just starting technology, you're not concerned about technology in terms of cash
again,
burn.
only even the manufacturing components, like when we're talking semiconductors, no, not as much. Utilities obviously have money coming through. I don't even want to see my electric bill this month. I've got 5 monitors and 2 computers running in here. But they have other difficulties with commercial source, but utilities still have to go, and they still have a regulated base, so they should be a little bit better on the burn rate. Obviously, we've discussed retail. That is a serious burn rate, especially when they start opening up. It'll get worse. Stores that are opening up need people in there. They need to be able to monitor them. You need to do the clean. So it's going to cost you more. So if I did furlough so many employees and I pull back some on those retail ones, large and small are going to be larger. That's a concern. For how long does it go on for, how the consumer reacts. Again, the government can only give them so much, and I don't think Macy's is getting that much money from the government.
What do you think? I mean, I know that they've now thrown a lot of the what we would formerly have considered technology companies into that communication sector. How that one seems to be pretty strong too, not too concerned about the cash burn.
Yeah, the old not dominating ones, AT&T and Verizon, obviously, had their own issues, always high yielders anyway, but still have the ability on there to maintain the cash flow, although they're both borrowing. They have high burn rates to begin with. They do a lot of capital improvements. Capital expenditures are up there. AT&T also does a good amount of buybacks on there. But you get things like Netflix, on Amazon, there's no buybacks, and they or Amazon pay a dividend at this point, along with Warren Buffett, of course, would be nice. But yeah, the burn rates on those are high. When you move to some other groups, the industrials, again, it's widespread. Boeing as compared to a small manufacturer, 3M. Okay, 3M's difficulty, they can't get enough people quick enough to make enough masks. Kodak, which just increased their dividends. They can't make quick enough. I can't get them quick enough. No wonder they're bootlegging them for here. So you get onto the industrials, the consumers, obviously the staples do better than discretionary, but if we start opening up, the discretionaries may take a jump if people spend money on there. But again, that's the big if on there. Energy we covered. It's going to depend on supply and demand. At the end, if we open up, it helps add more demand on there. Supply is getting a little bit better, but it's still high and probably one of the main issues on there.
So cash burn is an issue, and what about their ability to raise more capital right now to get through this crunch?
Oh, energy?
Yeah. I mean, so I would assume that the larger ones are.
Yes, we've seen the cash and the debt. We saw Exxon, obviously, who paid its dividend. They typically always pay increase in April. They did not this year, but they paid. But they slashed capital expenditures and a whole bunch of other items. They've been able to manage, and again, they're high cap, and they probably can still hit the fixed income market abroad as well.
Yeah.
at a decent rate, but that doesn't go all the way down once you get down to things like OxyPeat, for example.
Yeah.
They don't have the depth there, nor do they have as easy a time getting money. So cash flow becomes very important to them. Again, you need to be able to sell product to have cash flow.
Well, also, I mean, the $32 or $35 a barrel price is, for many of them, it's below what they can produce it for. So that's cash burn, right?
Look at the fracking, the ones that are still there, I mean, that was part of the fight, again, with Saudi Arabia and Russia. One thing they had in common, besides fighting each other, was let's get the U.S.
Let's get rid of U.S. fracking, huh?
Yeah, let's reduce it a little, we don't need a third one coming in there.
Yeah. Okay. So what about financials? And I think here, let's break it out a little bit between, say, insurance companies, annuity companies, mortgage companies, and maybe big banks.
Ooh. Okay. We did a bit on the big banks. The difficulty there is going to be their commercial loans, obviously, the real estate holdings, and the ones that have the charge cards. Again,
are you seeing any of this in cash burn yet, or do you expect to see some cash burn issues?
No. On the large, small banks will be able to deal. We have some numbers, but on the larger banks, it's hard because the cash is their product. So seeing what is actually burning and available is different. Again, the banks are in good shape right up to the day the Fed knocks on their door for the merger. Banks report cash, but that's counting the money I have in their account. That's, they can't spend that. I mean, Goldman has.
I thought it was only me that couldn't read these reports. I had hoped that you would.
I'm at S&P. I'm in my 44th year. Cash has always been a nightmare, and it remains it. But the bigger banks, again, the size does help. Plus, they have more the ear of the Fed.
Yeah. And then insurance companies were really a problem in the Great Recession. How about this time?
Yes. Enormous difficulty with insurance companies because within the U.S., similar to the situation with AIG, okay, you've got a parent, but they have 50 states. To get anything abroad or dominions, they have 50 states with 50 different sets of laws, rules, and regulations for requirements, for what you pay, for what you don't pay. This is going to be a big difficulty, the corona situation. Most of the insurance companies have appeared to say that's a natural disaster. They're not liable for it, which goes the whole gamut. Insurance, I was supposed to be in Greece now. I had insurance on that. They won't pay that. Natural disaster. The restaurants and the stores that are closed, coverage, well, that's not covered under that. So the insurance companies are going to have a big difficulty on that part. Plus, the interest rates are low, so they can't resell and make it up somewhere else.
Right.
And then you've got the pension funds, which are separate but associated. Guess what? If I have a pension, I have to get a check every month, whether you want to or not. That means you've got to go in there and decide what stocks to sell and what not to sell. That is a lot of downward pressure when the market is down. So anything that you sold at the end of March, when numbers were down, at the end, with the low March 23rd, anything you sold, that's a closed book. You lost that money.
Yeah.
So the insurance companies obviously going to have a tougher time on there, especially the casualty ones. And we expect a lot of litigation under there, same way we saw in 2008 and 2009, which may lead, I'm not in the term, class actions, as well as some drawn out situations.
And I think it's so heartbreaking because, it's really, if you ever get even a fraction of your money back, you've been through 10 years of sheer hell to do it, so.
Yeah, it's long and people settle for it. The last one I think you had was the local banks, which we said had more of exposure, to the direct loans to the businesses, the small business or mid-sized, to the mortgage, to the real estate locally. The positive item is they did handle the financing part, for the money from the Fed. They got a lot better press on there, and we're able to deal with that. But also, being more raw in general may help if they don't get a cluster within their area. A lot of the virus situations are in city where they're very dense. Yeah. I mean, the background you're using now, there's no people there. If I take you to the back of this room and open the window. Normally you would see thousands of people.
Yeah. All right, I'm going to give you the last word. I can't thank you enough for sharing your wisdom with us. Hopefully some people have been able to, really get a sober and direct, and I thank you for your transparency and your willingness to talk, brass tacks. So thank you. But do give us kind of a broad picture, overall view, anything that you'd like to say, and also maybe words of wisdom for the younger generation that are just coming into this and have never invested before, have never been through the Great Recession, or have never been through any of these downward trends.
I'll give you what I did for my kids. Again, in their 20s, the minute they started working, I opened up a Roth IRA for them, because unlike myself, they've had somewhat of a pension and some other money. It's going to be up to them. So young people have more of a responsibility for themselves, for their retirement, and for their health care. Yes, there's supposed to be government programs, but the bottom line is that you have to take care of yourself, and time is the best way to do that. Investing when you're 22 is so much easier than when you're 35 and saving for something, or you just bought that house, or you're looking towards your kid's college at 45, or retirement for yourself. So the younger generation really needs to be able to put money away. The difficulty here is that they won't see that money for 40, 50 years.
Yeah.
That is a hard sell to anybody. Give me money and I'll give it back to you in 40 years.
Yeah.
That change the rules on you. Also, as you mentioned in your opening, that these people do not all have jobs now. They don't know what the situation is going to be. So it's extremely difficult for them. I know when I got out of school, it was high inflation times, it was difficulties, but you always knew you were going to find a job, you were going to get something, you're going to do what you got to do. They don't have that of a background. They may not be able to get a job too quickly. They may not be able to save too quickly. So it's really a bad item on there. And hopefully, they'll be able to pull themselves up with the economy. But it's really not a good sight. I'm sorry to say that.
Well, I think also though what you're doing is an example of how families can pull together. You can,
yes.
It's not that your millennial or your Gen Z is moving back in because they're sponge and they don't like to work. It's a hard market out there. It was a hard market for them even before this, because wages weren't going to cover their debt, their college loan debt. It was still difficult. So, I think that I am seeing uptrends in intergenerational housing. It's still early in this game. And that's a new phrase. Before they were saying, the millennials, there were all these what I consider to be fallacies about the younger generation, but basically what you are saying, look, if you are younger and you do have a job, reduce expenses, contribute to your Roth, maybe
as much as you can.
Yeah, maybe start a health savings account. I think a lot of people are not even aware of the fact that, I think the health savings account sell is an easy one if you have a job.
If you have a job and a plan that admits that some of them are restricted to, high deductible situations, but the 401ks, which are the old pensions, obviously, most companies will contribute something.
Yeah,
and
free money.
Even if you're at the bottom of the market, you've got time on your side to compound it. And while we have probably deflation now, inflation will come back. So time is on your side, but you've got to be, it's hard to discipline. Again, give me 40 years, I'll give you something back.
Well, I always say it increases your wealth. It makes it easier for you to buy your first home at a lower interest rate. Building wealth is always a good idea.
But yeah, they are going to have a difficult time.
Yeah. All right, Monsieur. Thank you. And if you have any last words, but I think that was a good one, unless you have anything else you'd like to say.
Nope. Just be careful out there. Know your own risk tolerance. Know your own liquidity. Okay. Everybody wants to make a buck, but the bottom line is if you can't afford to lose it, don't bet it.
Oh, I love that. And one last thing, because I am going to pivot this for Thrive Global is more about mental health. Can you give us a little bit about how you can reduce concern and worry, maybe by diversifying or whatever it is, any words of wisdom there? Because you said if you can't lose it, don't bet it. But there's a difference between market timing. Like market timing is not going to reduce the worry or the concern, because then the markets go up and you have FOMO. fear of missing out.
And timing is the hardest thing to do. Time is go out and do the worst over time. You just can't pick a winner every time.
Right.
What you do. But as far as the stress on the financials, yes, diversification is important on there. Again, we spoke about the indexes, how tech is up, yet you've got 30% losses in 37% losses in energy. Using a consolidated item, it could be an index, could be a basket, however you circulate it. And there's lots of instruments out there. You need to diversify it. Do not try to peak it out at the top, just like a dividend stock. Don't get the highest yielding one. Get one that's going to keep paying you. So you need to diversify to some degree, and you need to find somebody who you trust to help you, because it's not that easy to do. And you see all the professionals who do not do it right. There's got to be a reason. It's not that easy.
Very good last words. Thank you so much.
Thank you.
All right, that concludes my interview with Howard Silverblatt. Howard, again, thank you so much. This is just a treasure trove of information. And for those of you that are interested in watching this back, remember, just go to youtube.com/Natalie Pace 2. If you want to make sure that you participate in upcoming interviews, then reach out to our team. You can either info@nataliepace.com is the email. 310-430-2397 is my our office number. And again, we are in the business of financial wisdom. So we want you to be informed and empowered so that you can be the boss of your money. Because even if somebody else is managing it for you, you should know what you own. You should know why you own it. And you should not just have blind faith. Thank you.